Nitin Jain, the President and CEO at Edelweiss Global Asset Management as well as Wealth Management. Nitin, such a pleasure having you on the show today. Welcome to ET Now Wealth Managers. And one of the biggest wealth managers, 90,000 crore rupees, Nitin, in assets under wealth management and 70,000 crore rupee assets under asset management. That must be a tough job for you.
Thank you so much for having me here. I think it's a responsibility, and we are grateful to the clients who have trusted us with so much of assets and so much of money. But I still think it's actually, from a global context, it's actually a very small sum. Just to put in context, we are broadly managing around $24–25 billion of assets. One branch of Charles Schwab in New York would be managing.
So how soon before Nitin Jain becomes Charles Schwab?
I think we have to keep context. I think this is a great space to be. Over the next 5 to 7 years, I think this industry should grow manyfold. And we need to do a lot of things right. We need to execute very well, but there's a lot of opportunity out there, and I hope that some of the firms, including us, capitalize on that opportunity.
If we were holding this interview at start of 2017 in the month of January, you would have said that irrespective of whatever your risk appetite or age group or what purpose you're looking for asset management, just put all your money in equities. Zero debt, zero gold, zero real estate. But given the kind of market environment, has that asset allocation math completely twisted and changed?
No, absolutely. But I don't know, why would you say that? You never asked me that question ever.
I did not. I said if it was a hypothetical question, if we were doing this
actually, to be honest with you, if you go back and see, as Edelweiss, we are actually not a very equities focused house.
Okay.
It's very interesting. We have been very consistent that the real alpha in wealth is never any asset class. It's always asset allocation. If you don't get your asset allocation right, over a period of time, you can never create wealth. In fact, there is this obsession around single asset classes. And I think in India, there are these long periods of time where one asset class tends to do well, right? So for example, there was this period of 3 or 4 years, I remember, where there was so much talk about gold and silver. I don't know whether you recollect.
Yeah.
And everybody told us, you know, how smart it is to buy gold. And there were everybody, even my mother and my grandmother, everybody was telling me that, you know, Nitin, you are in a wrong business. You should not be doing equities. Then that phase died down, and then for another 5–6 years, real estate became that craze. Between 2010 and 2014, whatever you touched in real estate,
you were sitting on a gold mine. Yeah.
And I think from 2014 to 2019, even today, if you see, if you're in equities, except for the fact, unless you were a very late investor, you have done very well. So even today, if you are looking at a 1-year return, in most of the funds you would be doing all right.
Yeah.
But I am not convinced that you can be so skewed in your asset allocation towards any one asset class. I think you would see volatility, even in equities. Whether that will happen this year, whether that will happen next year, whether that will happen next year.
It's already happening, Nitin. If you're not, if you're outside of those 15 stocks, you're getting mini heart attacks already.
Yeah, it is. Yeah. But you'll see a lot more.
Oh, really?
You'll see a lot more.
So not taking concentrated action is the fundamental or the principle that you follow.
Absolutely.
What is the ideal asset allocation given that you're bracing yourself for heightened volatility already?
So I think you should look at diversification. What do I mean by diversification? Of course, people talk about fixed income, you talk about real estate, you talk about gold. Gold still is an important asset class to have in a portfolio. I'm not talking about having 25–30%, but a 10–15%. Especially given the context in terms of currency, given the context in terms of fiscal deficit, where we are heading and all, it is not a bad thing to have a good balance of 10–15% in terms of gold in a portfolio. A lot of our high net worth clients also like to have yielding assets. So stuff like commercial assets. A fund that we launched recently, which was basically an infra fund, which was something like buying operating assets like roads, transmission assets. These are assets which give you 11-12% running yields. It's like buying a commercial building, but also can give you potential upside eventually from a capital appreciation. We have done distressed funds. We have done other credit funds, including RE funds. So this can give you a 15 to 20% high yielding, balanced asset allocation. And then you can have 20-25% in equities. So 20-25% in equities, or 20-25% in high yield instruments, and the rest in a combination of real estate, fixed income. And you can swing this a little bit depending on your own risk appetite, horizon, and your own familiarity with the instruments and all. But a balance is what is required for a portfolio. And then you have to constantly monitor and then keep on tweaking depending on the market cycles, depending on your own needs as they're evolving. So it's a little bit of a hard job.
It sure is, which is why I said tough job it is that you have at your hands.
Yeah.
So let's take these equity asset classes one by one. When you say 20-25% equities, is it direct equities? Is it the safer bets, mutual funds? Within mutual funds, there are so many products out there. Do you go for balanced fund? Do you have debt exposure as well? Do you go for small caps because they're available so cheap right now? Maybe they'll fall a little more, but right now may be the right time to start nibbling it. Or do you stick with quality because you should be risk averse? Like you said, there is going to be more volatility, and they're the ones wherein there is visibility of growth.
So I'm not a big fan right now of mid and small cap. You can get upside for sure, but from a risk adjusted return point of view, I think there are enough multi-cap funds which can swing a little bit between large cap and mid cap, and which give you flexibility and liquidity. I would prefer those kind of funds. Second, between direct and mutual funds, I'm very clear. If you are not a professional money manager, or if you are not very familiar with equity markets,
You're not savvy enough.
if you're not savvy enough, ideally you should be in mutual funds. If you have a good understanding of a particular sector, or you're familiar with some companies, and if you have 10-15% in direct equities, it's all right. But to have a large part of your allocation in direct equities mostly has not done very well for clients.
So do you have a favorite list of balanced funds or multi-cap funds?
Edelweiss multi-cap fund, Edelweiss balanced fund.
I should have
Two of my
guessed.
favorite, yes, they are.
I should have guessed it. Why gold? Why right now? Purely because it's going to be a hedge against the currency? Or do you believe कि कभी तो ऊपर आएगा?
No, two reasons. One, as I said, sometimes it's a great hedge for volatility. If my view is that the world is not in a good place. Now, this is not about India. You look at the global macros and you see the talks of the trade war and the way the interest rates are going up, and just the macro headwinds that we are seeing. Plus, you add to that the issue around the currency. If the trade war escalates, and I'm not in that camp that it will, and if for some reason it will eventually, if that was to happen, it can have a meaningful impact on the currencies, right? And if currencies start to depreciate, then you are very exposed. The only hedge then you have is gold. You'll be surprised. At that point, the only asset class that will do well is gold. So just from pure diversification point of view, it's important to have gold. It's not a bad thing that it also is useful.
Oh, absolutely. I'm all for it. No, but besides that. Okay, so gold is done, equities is done. What about real estate? I mean, are you a fan as an asset manager?
Actually, for a long time, we've been advising against it. But I am now beginning to see green shoots. I might be probably in minority right now, but I do believe it's bottoming out. The new launches are very few and far in between. A lot of money has to be made in credit. A lot of money has to be made in credit. Credit is the new equity. In India right now.
You just give me the tagline for your segment.
So much of dearth of capital. Given the fact that the Indian banking system is really not firing, but the economy continues to do well, there's so much need for capital. And I think a lot of funds, AIFs and credit funds, which will provide mezz capital and other forms of capital, growth capital for companies, which will compete with private equity, I think will deliver far superior risk-adjusted returns than some of the equity funds also. And they will also give you good cash flows over a period of time.
What kind of investors get attracted or are open to investment into your infrastructure
Most
fund?
of
Is it the high risk takers, or is it more the safe playing ones which would say, okay, yeah, I'm willing to put in my money in your infra fund?
Actually, that's a great question. So first of all, because it's a AIF, so you have to have a reasonable amount of wealth,
minimum
because minimum allocation
yeah.
is 1 CR. So most of the guys were ultra high net worth. That's the starting point.
But even within that, I'm guessing there are some who are saying, nahin, mera hard-earned money, you can't put it in an infra fund.
I have hardly
or
met
some
somebody.
risk takers.
Most of them actually took it from their fixed income allocation. So
That's
this
interesting.
Yeah, so this, they didn't see it as an alternate allocation. They saw it as a fixed income allocation.
Swap.
A swap.
Yeah.
They thought, rather than putting this money in a fixed deposit at 7.5%, why not move it into a NHI bond equivalent effectively, not complete.
So they're looking at it as safe and as matured an investment call as they would have.
They're very savvy. They're very savvy.
A fixed income instrument.
Fixed income, not fixed deposit. There's a difference.
Oh yes, yes.
It's a fixed income instrument.
Yeah.
Because eventually these are annuity, but this is not comparable to a fixed deposit because you are getting a higher yield. There are inherent risks in the product, but the fact is the differential is meaningful. And the reality is today, globally, who are the biggest buyers of these operating assets? Pension funds, sovereign wealth funds, asset managers. But in India, there are no pension funds who buy these assets. So what happens is that there is this huge supply of assets who want to sell. But there's
there are
no buyer.
No takers, there's no capital.
And then there is this huge number of people who are looking for yield. What you need is aggregators here and you need aggregators here. That is what we are trying to do. Buy these assets, aggregate this demand.
Make the two meet.
Make the two meet.
Tell me a little bit more about this distressed fund of yours. I understand that it's part of the ISIF too. What is the definition of assets that you're looking at? Because traditionally you would think textile sector, you would think telecom, you would think real estate, you would think power. What else? Or metals also?
Yeah. No, you've highlighted quite a few, but I think a company can be in distress for multiple reasons, right? Some of the times we have seen the sectors have done very well.
But within that, a
company has gone in distress. For example, we have a paper company, we have a pharma company. These two sectors have not done very poorly, right? But the companies got stuck because of some unique situations that they got. A cement company. So we have we have a reasonably diversified portfolio. But the way we define distress is basically when they have defaulted on the bank or on any creditor.
Okay.
Once the company
So you're not looking at the borderline cases which are about to default and who come to you for rescue. You're not looking at those, are you?
We do. To be honest, we do, but that is 20% of the cases. Okay. More often than not, these are cases when they have actually defaulted. And our job is to basically then find a solution for that. So we will go to the banks and buy out their debts, or we will go to the promoter or provide him more capital to allow the banks to take back their money. Sometimes it will be some discount to the original loan or principal or whatever that price is. But we find some creative solution to solve this. Then the key though is to understand why did the company go into the mess in the first place. And there are typically two reasons. Outside of the fact that the industry was in a bad situation. So either you were indisciplined in your financial management or your operational management. So we have two teams. One is a team which manages your finances. So we are not going to tell you what your strategy should be as a businessman, but the cash flow monitoring will be in our control as a team. So any money that comes into the system and any money that goes out of the system is controlled by our operating team. The second is the turnaround team, which will ensure that the operations are overseen, not operated, meaning the budgeting, the purchase, the sales functions. They are very keenly watched by our team along with a couple of consultants. It can be BCG, it can be McKinsey, it can be Alvarez and Marshall. We will appoint them and they will work. So they will provide us reports whether the operations are streamlined. We are not making any big mistakes there. So with these two capabilities and restructuring, we are typically able to provide meaningful solutions to the companies. And in lieu of restructuring, we typically end up getting some equity into the company. So we get bare minimum returns of 15 to 20% on our debt, right? Because it's a distress situation. But we hope to make more because of our equity into the company. If the company turns around, then not only do you make your returns on the debt, but you also make your returns on the equity. So that is the...
So, I mean, I'm guessing it must be only high risk takers who are open to deploying their money for distressed assets?
So tell me, when you buy equity, would you call it as high risk taking?
You're asking the wrong person. It's my profession. It's like me asking you about distressed funds.
Okay, maybe let me answer this question differently then. See, risk is a function of your understanding also. How much you understand also defines how much you see risk in a particular thing, right? I think right now, distress is definitely not a risk-free investment. But given the entire spectrum of credit, I find it the most superior risk-adjusted return.
So Nitin, if someone has to portfolio plan for say the next 10 years, give me two different portfolios, one for an extremely conservative traditional investor and one for the high risk taker who's chasing the alpha in the market across asset classes.
Across asset classes. So let's go for the conservative guy like me. Maybe it will be a 10-15% gold, right? Maybe it will be 35 to 40% in fixed income, but mostly mutual funds. There will be 10-15% in alts, the kind of funds that I talked about, high yielding, and 25 to 30%, but mostly in multi-cap funds. So 30% equity, 70% fixed income and gold, but within that I said I will do a mix and match between, and real estate I will do only opportunistically. Maybe I will do it through a fund structure if it is required. But if it's an aggressive guy, maybe I'll increase the equity allocation to maybe 40, 45. Maybe I'll increase the alt allocation to 25, 30. Maybe I'll reduce the fixed income allocation. Maybe I'll reduce the gold allocation also to 5%.
But within equities, you will not take those concentrated.
Yeah, so maybe I will.
You will go with multi-cap.
So in the aggressive, maybe I will go increase. I'll change the mix. Maybe I'll increase 10% allocation to mid-cap funds. But there, one has to be clear that it's not a 3-year call. It has to be a 5 to 10-year call.
So you're not betting on the return of mid-caps for the next 3 years, are you?
So I'm not saying that, but I'm not convinced the next 3 years you can deliver meaningful alpha.
Not like 2017. For
sure. So that I might be proven terribly wrong, but I would still bet on large caps right now for the next 2 to 3 years than on mid caps.
What's that one disruption or that one big trend which you could safely bet on, say, for the next 10 years?
I think there are 2 or 3 themes which are emerging as an industry. One, I think people are becoming more and more aware that FDs are not going to solve their investing problems, right? More than 100 lakh crores or some such number is in either of the savings account or current account or FDs in India. Interest on that every year is 7 lakh crores or 8 lakh crores. The total fixed income mutual fund industry is 6 lakh crores. So every year, just the interest on fixed deposit savings and all this is greater than the
total AUMs.
And I think it's a bizarre thing. It has to shift.
It's already begun.
It's begun.
Slowly.
But I think there will be a tipping point. We are not able to crack the distribution problem. The problem is that for banks, it might not make sense to do this transition, right? Because they are the beneficiary of this, and a lot of advisors sit in the banks. So for them to move clients from fixed deposits to this will not be a natural transition. But for wealth managers like us, it's a great opportunity, and I see that as one of the big drivers for growth for us. As long as that money is sitting there, we should find ways of reaching there and moving that money. That should be an easy one. That's one. Second is advice. I think only 10 to 15% of the total wealth in hands of high net worth today we feel is advised. Most of it is either self-directed or advised by your chartered accountant or somebody that you know who's not qualified per se to advise you.
Someone in the family.
Somebody in the family who you know, and suddenly you are realizing that earlier it was, you buy this property or you buy this real estate and all of that.
Why don't you also buy there? Yeah.
So, we lived in a very high inflationary regime where the interest rates are very high, and anything that you buy, any real estate that you bought, the prices have gone up. But in the last 4 or 5 years, the value destruction has been massive. And a lot of wealth has got destroyed and has got stuck. So that shift is happening. People are moving from this unorganized to organized. Very big shift. And that is why suddenly you are seeing a lot of wealth managers. It's not a new industry, right? I mean, all of us have been in the business.
They were always there, but you never thought you could approach them.
Yeah. But suddenly people are now coming to us. And I think the other trigger for the same was demonetization. I think a lot of people didn't realize
financialization,
the impact, but this entire wave of SIPs and asset management, assets growing in wealth, it is all linked. Sometimes, the idea just comes. So I think a lot of this got triggered by that demonetization also. So moving from unorganized to organized. And I think third, the time of credit and alternates in general has come. This entire, as an industry, I think alternates will be a key driver of growth in asset management.
In the next 5 years, what's the ballpark figure that we're looking at in alternates?
In alternates, I would be surprised if it is not as big as equities.
What do you say?
Yeah.
Okay, we'll wind up the discussion.
Ayesha, it was such a pleasure. Thank you so much.
Thank you so much. It was great learning.
It was my pleasure.